Hi, you're watching CNBC TV18 and the big TCS numbers are out. We're starting with the big takeaways. Net profit at 11,074 crore rupees versus CNBC TV18 poll of 10,866 crore rupees. The rupee revenue is at 59,381 crore rupees versus CNBC TV18 poll of 59,450 crore rupees. The big numbers are EBIT at 13,755 crore rupees versus CNBC TV18 poll of 13,922 crore rupees. So numbers are flashing on your screens. TCS has also announced the interim dividend of 9 rupees a share. So this is the TCS earnings snapshot on your screens. So the net profit for Q1 has come at 11,074 crore rupees versus the CNBC TV18 poll of 10,866 crore rupees. EBIT margin is at 23.2% versus CNBC TV18 poll of 23.4%. Rima is joining us for more on this. Rima, thank you for joining us. What are the key takeaways of the TCS numbers?
Okay, so I just have the very basic numbers with me, and it looks like it's a largely inline set of numbers. So the two key numbers we look at, one is constant currency, so I still don't have that number, but EBIT margins at 23.2% is a decline of 130 basis points on a quarter-on-quarter basis, and this is slightly more than what the street is anticipating. The reason we were expecting the margins to decline is on account of the wage hikes. Remember, TCS doles out wages from the 1st of April, so the reason for the margin correction is the wage hike. The company has also announced deal wins at $10.2 billion, which is slightly higher than the $10 billion a quarter ago. The company's guidance on the deal wins is that on a quarterly basis, deal wins will be in a band of $7 to $9 billion. But this time, the street was anticipating a number ahead of $10 billion, considering the slew of large deals, the spate of large deals that the company has won in the recent past, whether it's with the Phoenix Group, M&S, the Nest Group, which was a large $1.9 billion deal, or the BSNL deal. Constant currency revenue growth has come in at 7% on a year-on-year basis. This is, after, I think, 9 quarters, in more than 2 years, the revenue growth has come in single digits. For the last 2 years, the company's growth rate on a year-on-year basis has been in double digits. But this time, revenue growth at 7% has come in single digits. We don't yet have the constant currency revenue number on a quarter-on-quarter basis. The hiring number continues to remain very muted. This quarter, the company has hired 523 employees. This follows about an 800 headcount addition that they had in the prior quarter. So hiring continues to remain on the weaker side, and attrition continues to inch down. So in a nutshell, these are okay set of numbers. You would say they're largely in line with street expectations, but it's the predictable slowdown. The results are reinforcing that there is concern on the growth front. There is uncertainty. I think now what we need to assess from the management commentary is the slow growth going to remain for longer? Is it slower growth for longer, or do you think we can see some revenue acceleration as the year progresses? To read out the statements coming out from the top team, K. Krithivasan, who's taken over as the CEO and MD from 1st of June, and this is the first time he will be addressing the press conference. He says it's a very satisfying start to the new fiscal year with a string of marquee deal wins. We remain confident in the longer-term demand for our services, driven by the emergence of newer technologies. We're investing early in building capabilities at scale on these new technologies and in research and innovation, so we can maximize our participation in opportunities. Samir Siksaria says we have gone ahead and rolled out our annual salary increase effective 1st of April. Operating margins of 23.2% reflects the 200 basis points impact of this wage hike, offset through improved efficiencies. At the same time, we continue to make investments needed to power our future growth, including expansion of our delivery and research infrastructure.
Right.
So we don't have too much clarity in terms of the demand environment for the way forward. About the internals, the FSI growth rate has slowed down.
Okay.
The FSI growth rate has gone up by, improved by 3%, and this is slower than what we've had in the last couple of quarters.
All right, Rima, thank you. Please stay on with us. I'm also joined by Moshe Khatri, who's Managing Director, Equity Research at Wedbush Securities. Mr. Khatri, thank you for speaking with CNBC TV18. The numbers are largely in line. What do you make of this?
Not a huge surprise. The feedback we're getting throughout the quarter was that since the mini banking crisis back in March, things have stabilized. Remember, it's all relative here. So relative to the noise and to the kind of the feedback that we got last quarter, it seems that funding for large deals is actually coming through, especially on the cost takeout area. I'm assuming that's why the deal wins look pretty healthy. The margins on a relative basis also kind of in line. The real question here is, are we going to see that second half uptick for fiscal 24 that everybody was kind of looking for? And, it's a possibility, especially if we see these deal wins continue into the next quarter. And the feedback that we're getting as of yesterday, it seems that the demand for lateral hires is actually picking up, but it probably, gets on the bench only during the December quarter. So you have another quarter that's going to be with muted earnings. And then the second half of the year, hypothetically at least, could look a bit better.
Right. I'm also going to read out the other set of numbers that are coming in. So Rima already mentioned about attrition rate, which is at 17.8% versus 20.10 Q on Q. Then the dollar revenue number is at $7,226 million versus CNBC poll of $7,233 million. Revenue growth has come in at 0.4% Q on Q versus CNBC TV18 poll of 0.5%. What do you want to say about the dollar revenue number that's come in at $7,226 million as opposed to the poll of $7,233 million?
Muted numbers in line. Remember, expectations for the group have been very dim and very negative. So it's probably in line, maybe a bit better than feared, not spectacular, but it was kind of expected. And it'll be interesting to see what management has to say about visibility, especially given the deal win number that I think it looks very impressive considering the overall environment.
Moshe, just want to throw some internals. BFSI is a spot of bother this time. BFSI year-on-year revenue growth is coming at only 3%. This compares with a 9.1% growth in Q4, 11% growth in Q3, 13% plus in Q2, and nearly 14% in Q1. So BFSI growth rate has been faltering for the company, and this time it's come in at just 3% on a year-on-year basis. The management had cautioned about rising stress in the financial sector, particularly with clients in North America, where clients are looking to conserve their capital and not spend it. They were in a bit of a capital conservation mode. That's what the management had told us last time around. And the stress in BFSI is still very much there. The other vertical where growth has slowed down materially is the communication vertical. Again, this was flagged off by the management last time, but this time growth rate is just up 0.5% on a year-on-year basis. This is much lower than the 5.3% that we had in the last quarter. And before that, the company was seeing a near double-digit growth rate in communication. So BFSI slowed down materially. Communication has practically seen a flat growth. Where the company is seeing strong growth yet again is the life sciences and healthcare. It's a double-digit revenue growth for life sciences and healthcare. In terms of the geographies, North America has again clocked in a weak growth, just 4.6% on year-on-year basis. UK has been very strong for the company, 16% year-on-year revenue growth. So this is largely played out as what the management has said. If you remember in Q4, they had told us that BFSI is weak, communication is weak, North America is weak, continental Europe is seeing some slowdown, but UK is holding up, and all these segments have slowed down materially for the company. Moshe, I think the question really now is that a weak Q1 is priced in. A subdued Q2 is also probably baked in the cake. But what about thereafter? Do you think we could see some revenue acceleration growth pick up in the second half?
as I said, the deal win number looks pretty impressive. So it's a function of how quickly they can ramp. And then if you have another quarter where we're starting to see maybe some funding for some of the smaller, maybe consulting deals that get ramped much quicker, that could also be a positive. As I said, the indicator or the indication from some of the staffing firms based in India as of yesterday is that demand for lateral hiring is actually picking up. And these are people that will get deployed as soon as they hit the bench, or as soon as they get hired. So it seems that maybe visibility will be better for the second half of the fiscal year. And if that's the case, you could actually see that pickup. And again, we're not talking about a robust pickup, but will be a positive kind of inflection point, maybe starting in the December quarter.
Moshe, thank you very much for joining in. We've got Prakash Diwan with us on the show. Prakash, this has been a predictably weak quarter for the company. No positive surprises. It's not a big miss versus expectations like we had in Q2 with most of the large cap IT companies. It's still a very muted quarter, flat constant currency revenue growth on a quarter-on-quarter basis. So absolutely no growth in a seasonally strong quarter. Margins have fallen by 130 basis points. But there's nothing in these numbers which inspires confidence or, will allay the concerns that the bears in the market have. How would you read these numbers?
So, Rima, you said two things. One is whether the numbers inspire confidence, and the second is whether they allay the fears that the street has been demonstrating or anticipating. I think it's the latter. What it does is it tells you that things aren't going to be worsening from where they were, let's say, on the last quarter of FY23. This could have been a very strong quarter in normal circumstances, but let's face it, the recessionary trend in spending is very evident. Very clearly tells you none of the companies, especially, if you look at verticals, I don't know if you discussed that, but the BFSI continues to be languishing at a very, very moderate rate of growth. I mean, there's hardly any growth out there. You probably don't have much of other areas which are contributing, except for maybe the life sciences segment, which tells you that the broad bread and butter business of most of these large players is still under the cloud, and till there is a very clear change in direction, change in trajectory for some of these, and that will probably, once we know the order wins, which this 10.2 billion, what do they comprise of? Then we'll probably know that, how quickly Q2 could recover, or not even Q2, maybe beyond that. So I think the street is going to be looking at indication of whether things are worsening from what the indications were in the last quarter gone by, or whether they continue to be able to survive this slowdown and not given in terms of, operating metrics. So this looks like that. The operating metrics don't seem to have succumbed to it. There's no capitulation on any of those accounts, even on the margins for that matter, to be honest. But my sense was there could have been some impact on the margins. The margins could have been much weaker, but they've probably been in this thing. So there was no anticipation of very great numbers in any case. So these numbers, from that perspective, are just in line. Yeah.
All right. Thank you so much, Mr. Prakash Diwan, Moshe Khatri and Rima, on the big headline that we are tracking on CNBC, which is that TCS Q1 numbers are in line. Moving on to another big headline that we are tracking, that is the key takeaways, the key decisions of the GST Council meet. And the biggest of them was the levy of 28% GST on online gaming, casinos and horse racing. For more on this, I'm joined by my colleague Parikshit Luthra. Parikshit, what are the details in the industry reaction on this big development?
Well, we have been getting strong reactions from the industry, especially the gaming industry. And this is with regard to the 28% GST clarification that's coming in for online gaming, casinos and horse racing. The tax will be levied on full value. The gaming industry has called it a big setback. That's not all. The council has also clarified that all multi-utility vehicles, whether SUVs or crossovers, will have to pay a tax of 22% compensation cess over and above the 28% GST rate. Let's